Good morning, everyone, and thank you for joining us. My name's Michelle Waitley, and I'm the Specialised Business Bank Executive for Commercial Real Estate at NAB. As we begin today, I'd like to acknowledge the traditional owners of the lands on which we meet. I'd like to acknowledge the Wurundjeri people of the Kulin Nation as the traditional custodians of the land on which I'm joining you from in Melbourne, and I'd like to pay my respects to all elders past, present, and emerging. Welcome to our final property market webinar for 2024. This year, we were joined by some fantastic speakers who presented on the retail market, net zero carbon buildings, and residential development. Our topic for today is the industrial market, which has been the strongest property asset class over the past couple of years, but we're seeing some emerging trends. Have rental rates reached their peak? Are yields softening? Is there still depth of demand from both tenants and purchasers? These are some of the questions that our speakers will address in today's webinar. Joining me today as guest speakers are Annabelle McFarlane and Trent Cropley from JLL. Annabelle is an accomplished professional in the property industry with over 30 years' experience across Australia, the US and the UK. Annabelle joined JLL in 2015 and currently serves as the Head of Strategic Research. Leading a team of researchers, Annabelle produces innovative thought leadership on investor trends, sustainability in property markets, city growth, office precincts, the industrial sector, and land supply. She's published several research papers on these subjects and is highly regarded in the commercial property industry. Annabelle also lectures in property valuations at RMIT in Melbourne. Trent is the Senior Director with JLL, leading the valuations team in Brisbane. He specialises in the valuation and advisory of industrial assets. He is a Fellow of the Australian Property Institute, a member of the Royal Institution of Chartered Surveyors, and a registered valuer. With over 15 years' experience in the industrial sector, Trent works with all active participants in the market, which allows him to maintain a holistic view of the asset class. He values industrial assets, both freehold and leasehold, at price points ranging from $2 million to over $500 million, and his critical analysis of market conditions and the unique property attributes provide the foundations for his expert advice to his diverse client base on investments and new developments. Thank you so much for joining us, Annabelle and Trent, and we look forward to hearing from you shortly. The industrial property sector is critical to our economy. As Australia's largest business bank, we are absolutely open for business. We have a very experienced property finance team, and with our deep understanding of the market, we look forward to working with you as your finance partners in 2025. We will have time for questions after the formal presentations. If you could please use the Q&A function at the bottom of the screen and we'll get to as many as possible. And we're also recording this session so we can share it with you afterwards. On that note, I'm going to hand over to our first speaker, Annabelle.
Thank you, Michelle. So I believe Kat's going to organise the slides for me. I'm very much looking forward to talking to you all about what we're seeing in the industrial logistics market in Australia. So that the headline really for us at the moment, I think, is balancing long-term growth fundamentals, but understanding the near-term pockets of risk across our markets. So, Kat, let's move on to the next slide. And I think the themes that we think of in research, the things that we think about, because we spend a lot of time, considering our forecasts. We've got the geopolitical and economic uncertainty and the recalibration of monetary tightening. I think we all know that there's plenty of geopolitical uncertainty. We've just seen the Middle East reach a new flashpoint. We've had Trump elected. Many of Trump's policies are potentially inflationary if those decisions around trade sort of get enacted. We've got an RBA that will probably today, I think, leave the cash rate on hold, which is, there have been many groups forecasting a decline in the cash rate. It's very clear that coming in of the cash rate will be not as much as some people would like, and probably further delayed. So I think the earliest, I'm not quite sure when NAB's forecast for 25 basis point cut is, but it's not as much as many were forecasting, say, a year ago. We've got lots of long-term growth positives for industrial in Australian markets, but we'll talk about the near-term pockets of risk. Climate-related financial reporting is here. We've got to be slightly aware of this, although I'm not going to talk about it a great deal today, because it will, in fact, it'll impact all businesses, and that's relevant for occupiers and industrial sector owners alike. And we'll talk a little bit about what the impact of supply at the moment, the construction costs, etc. I won't. The state-based property taxes are certainly causing challenges for the Victorian market, and then we'll talk about whether we've reached that valuation trough and how we're seeing some groups starting to capture the upswing. Right, next slide. This is a global transaction volumes slide from JLL. What we're doing is tracking the investments into real estate asset classes over time, and you can see that industrial and living have accounted for 50% of all global transactions since 2021. The industrial sector kind of arrived as an investable asset class at that time. It was really, really accelerated through the pandemic, and that trend is still there. I will add that in the absence of really much of a living or multifamily sector here, which is our build to rent sector, I mean, really Australia has nothing like the multifamily that stock as the US, etc. All the focus tends to be on industrial and logistics. When I talk to offshore groups, they often ask me, talk about industrial logistics, talk about living, knowing that full well they won't be able to find the asset classes. And funnily enough, it's just started to be a conversation about office again. But for 6 months, no one wanted to talk about office. So I think this is an interesting dynamic, but industrial is always up there. Next slide, please. Kat? Thank you. Transaction volumes globally have been severely impacted by rising interest rates, cost of finance, etc. But what's pleasing, in the first 3 quarters of 2024 in Australia, we're starting to see transaction volumes start to pick up. In fact, they're 39% higher than they were for the same equivalent period last year, which is really positive. And you'll notice that industrial, since the pandemic, has maintained its position as 35 to nearly 40% of all transaction volumes in Australia. So we expect that trend to continue largely as the asset classes become more institutionalized. Next slide, please. I think it's fairly well known how much pain the office sector has been going through. I think if you look at how we expect values to move in this cycle, the industrial sector has had some negativity through this year, depending on the market you're in and the precinct you're in, but it's nothing like the challenge that has been experienced by the office sector. Melbourne CBD office, we're talking over a negative 30% correction through this cycle. In terms of office, we don't think we're out of the woods yet, which is so different from industrial. There have been so many positives, and you can see the capital values have actually started to increase in 2024 in Melbourne and Brisbane markets. Sydney will be positive next year as well, according to our numbers. You'll notice that retail has been pretty, relatively speaking, has started to recover as well. Our next slide shows the yield story. And many of you will be familiar with this. Industrial has become the flavour of the time. It's been you can see the yield chart on the left showing that, historically, with a long career in real estate, industrial was always the weakest asset class in terms of always with the softest yields. Through the pandemic, it experienced the sharpest yield tightening. It has now bounced back out, but we still think going forward, industrial yields will certainly be tighter than office for the foreseeable future, and probably more in line with the core assets of retail. The chart on the right shows what we had as the yield point for various markets for both industrial. Industrial is the group on the left. In the middle, we've got the office markets, and on the right, we've got retail. So the point I want to make about this chart, Melbourne versus Sydney, we're starting to see the spread between Melbourne assets and Sydney assets really widen in terms of yields. It's happening with all asset classes, and it's certainly happening since about mid-year, when the reality of the Victorian tax changes came through. The foreign owner surcharge has impacted offshore groups coming into Victoria, 4% surcharge, land tax surcharge. And in addition, we've got the changes to stamp duty arrangements for commercial property, and that is also impacting probably, I mean, Trent might be able to expand on it a little bit more, but as far as we can see, there is more the complexity rather than the actual change, which will need to be worked through. But it's certainly, we've only just started to see offshore groups say, well, hang on a minute, Melbourne is now starting to look really good value. Next slide, please. Thanks, Kat. So let's talk about some of the really strong long-term fundamentals. I think it's easily forgotten that Australian cities, and we talk about greater metropolitan areas here, benefit from incredibly strong population growth projections and really solid GDP growth projections. Now, this is Oxford Economics' latest forecast. And what's so extraordinary is that Delhi and Shanghai and Beijing are the only metropolitan cities that are expected to outperform Australian cities in terms of GDP growth. In terms of population change, Perth, Brisbane, and Melbourne are expected to be grow faster than even Delhi. So if you think about that in terms of how population particularly impacts all real estate sectors. For office, it's where we work, and yes, there are some other changes, structural changes to the way we work that is impacting office markets. But it creates 200,000. So I'm talking about Melbourne actually at the moment, but there'll be enormous demand for residential dwellings just purely because of population change over time. We think over the next 5 years we'll need 200,000 more dwellings in Melbourne, for example. And for industrial, if you go to the next slide, you can sort of see the impact. In terms of number of per people, that change, Melbourne, Sydney, Brisbane, Perth, you can see those cities on the left chart are going to attract more people, accommodate more people than both London and Paris. On the right, if you take those people and you use the population change ratio with industrial construction over time, historically over time, and then multiply them with those forecasts. The chart on the right illustrates the kind of level of stock we are going to need to accommodate that kind of population change over the next 5 and 10 years. So, for example, the market that it really impacts is Melbourne. And you can see there in the next 5 years, it's going to be 2.3 million square meters of stock based on historical population ratios. Next slide, please. that's the pure population demand, but of course that's not the whole story. We've got consumer confidence bubbling along at a rather weak level. If you look at the operating profits by sector, and this on the chart on the right, we have manufacturing, transport and postal warehousing, wholesale trade, retail trade depicted here because they are all the biggest occupiers of our industrial space. You can see that only one sector, which is manufacturing, is really, really firing. And we're seeing this come through our take-up numbers. If we go to the next slide. If you see, you can see that through the pandemic, we had this incredible volume of gross take-up in our coming through all of our industrial markets. Pleasingly, the third quarter of 2024 shows that we are now bouncing back from a low point at the beginning of the year. And in fact, our Q4 numbers, which we're starting to work through right now, are also going to show some resilience and some positivity. But there are two conflicting sort of drivers of demand. There's the underlying expansion of population, and then there's also the weakness of the 3PL market, which is that consumer confidence element playing through. In certain markets, we have some anomalies. If you look at our numbers coming through our Q4, there's a lot of weighting to food manufacturing. So manufacturing is the star sector, food manufacturing, and weighting to things related to the construction sector. Many of our cities are going through massive infrastructure building programs at the moment, and they create demand for warehouse space. I think the other one that can't be discounted is that we're also seeing this extraordinary, is a bit of one-off, a story about hard stand at the moment with cars. There's a lot of new cars coming into Australia. It's mainly into Melbourne, which is where the cars come into the port. And for various reasons, there are a couple of main reasons to do with the US cancelling car imports from China at the same time as emission changes standards coming in Australia. We've had this influx of new vehicles, and they are sitting in secondary warehouses and on hard stand throughout our markets, which is just quite an interesting overlay to the take-up story. Next slide, please. We're all familiar, well, neither of us are all familiar, but sort of we're very familiar with this incredibly strong rental growth story that we've had in industrial markets in recent years. The net face rental growth by grade over the last 12 months shows that on the left here, which is all of our sort of industrial precincts we track, you can see really solid growth over the last year. Fun enough, the only market that really, but that is slowing. So the most recent quarter, there was very little positive face rental growth because incentives are picking up. The only outlier was actually in Adelaide, where in Adelaide we've seen further increases in rent this quarter, and incentives on average are just 5%. The incentive story is fairly dramatic in some precincts. Over the last 18 months, we've had some precincts, and most precincts now have come from those incredibly tight market conditions and have got up to mid-teens. But for example, in Melbourne's north, we've seen the biggest jump. It went from 7.5% 18 months ago to 27.5% in the Q3 quarter, which means that national effective rents are actually, on average, have actually slipped in the negative for the first time. You can see it on the chart on the right. You can see that all the markets, except for perhaps Adelaide and the southeast, Melbourne, are recording negative effective rental growth just at the moment. Do we think that's a long-term phenomenon? Do we think there's going to be a big correction going forward? We'll talk a bit more about supply dynamics now. So next slide, Kat, please. we've got, and the reason for all this is because we've got incredibly elevated supply in most of our key markets. And I want to just highlight particularly Sydney and Melbourne and look at the volume of under construction stock we have in those two markets, significantly above what we would normally have. Melbourne particularly, 1.1 million square metres, whereas historically we would normally have in a given year only 642,000 in a year. There's a remarkably healthy level of pre-commitment given the volume of stock that is coming through the market. Sydney's also got not a bad pre-commitment level. But I just want to highlight Adelaide again. There is a bit of stuff under construction. It is quite a lot more than we would historically get, but it's got a very high level of pre-commitment. And so this becomes the conversation we're having in all of our markets, is what is under construction? Is it pre-committed? Does it create a challenge for the given market going forward? And this is where we'll get a bit more detail around precincts. Next slide, please. Okay. Given the level of supply, we have to ask ourselves, can we see a further, is the demand going to keep up with that level of supply? Because it is so much higher than historical averages. I'm talking about particularly Melbourne and Sydney. And this is another way of looking at the demand story. We have e-commerce sales returning to a growth trajectory that we had pre-pandemic. Online sales got up to 14.3% in 2021. Then it dropped right back to 12.9% of all retail sales, and now it's creeping up again to 13.5%. It's like the pre-pandemic growth trajectory for online sales. The analysis on this slide looks at a scenario where we've got online retail rising to 20% of all retail sales. We're not there yet, but it's probably, and it's not clear how soon you could get to that 20% penetration rate. But assuming the growth rate continues at current sort of steady levels, over the next 5 years, that would push the demand for industrial potentially up to 11.8 million square metres nationally. Because the analysis we've done, it becomes very clear that the higher the penetration rate for online retail, the higher the ratio of industrial stock required per increase in population. So there's a population and e-commerce story combined. The next slide is another way of illustrating this point. If we think about Amazon's market share, it increased to 3.1% of all Australian e-commerce in 2024, which is the chart on the right. But on the left, just have a think about this. This is the square meters of logistics space per 1,000 residents in the various geographies that Amazon operates in. Now, Amazon is just one e-commerce major e-commerce operator, but relative to other geographies around the world, we are severely underrepresented by Amazon. So yes, our Woolworths, Wesfarmers and Coles are important for our e-commerce industry. We can absolutely see Amazon growing its market share going forward. That's what we expect. So these are the trends that support further demand. Next slide, please. We spoke a little bit about increased stock in some markets. What we've noticed is because that much of that stock is at the outer precincts. The outer precincts in our biggest markets are the ones that are having the biggest impact as a result of that supply. Outer vacancy in both Melbourne and Sydney markets is typically higher than the inner. For example, it's really very noticeable. It's not noticeable very much in Melbourne Southeast because that's just tight anyway. Vacancy in both cases is largely 1.6%. It's much more noticeable in places like Melbourne's west, inner versus outer west, which is 3.3% inner vacancy and close to 6% outer vacancy. And there's a similar story for Sydney markets. The rental growth performance is outperforming for those inner precincts. The urban infill precincts are where we're seeing the most strength in the market. Next slide. So given the level of under construction stock, we thought it'd be useful to look at under construction stock by the construction start date. So this is when did the construction start? And if you assume that typically a facility might take 12 months to complete, give or take a few months, what you can see here is this is all currently under construction stock. The stuff that is currently under construction in Q3 2020, that started construction in Q3 2023, you can expect to be completing either this quarter or next quarter. Stuff that's started under construction at the beginning of Q1 2024 is likely to complete going into the first quarter of 2025. If we go to the next slide, this at the moment is, so I'll go back again, sorry, Kat, I just want to explain something. This is the level of uncommitted space at the day they start construction. So back in Q3 23, all the stock that kicked off in that quarter was speculative development. None of it had pre-commitments before it started construction. Whereas you can see that stuff that is starting off in Q3 2024 and Q4 24, all of that stock is largely pre-committed. Developers understand that we now need to have tenants in place before you start construction of a new facility. If we go to the next slide, Kat. Pleasingly for those that started back in Q3 2023, today they're largely leased. They have leased up during the time of their construction. The worrying group is the ones that started a little later, started construction in Q1 2024. There's still quite a lot of uncommitted space there. We can expect that by the time we get to early 2025, there might still be quite a lot of vacancy around the market for the first half of 2025 because of those dark blue patches in these facilities. And thereafter, by the second half of 2025, we can start to see that volume of stock really drop off. So we get returned to a tighter market, less of a supply risk. Next slide, please. This is a very high level. We're very proud of actually producing a national industrial stock and vacancy figures for, at the moment, it's just the Eastern Seaboard markets at the moment. We'll be rolling out the other states throughout the first half of next year. But you can see the vacancy ranges between 3% in Melbourne and closer to 4% in Sydney. Sublease space at a very high level is slightly more present in Sydney. In both markets, it seems to be that it has ticked up. It is still ticking up, the sublease space, and it's actually just more relocations around the market, having tenants going in and out of sublease space being reabsorbed. So it's not sitting around necessarily, or some of it's sitting around, but some of it's being moved quite positively. Brisbane doesn't really have a sublease story, which is quite interesting. Next slide, I'll go into a couple of the details of these Melbourne and Sydney precincts now. Kat, next slide. I think the highlights from Melbourne, we've got 29.7 million square metres of total stock. It is the biggest market in Australia. The one precinct I do want to highlight is Melbourne South East. 1.6% vacancy is the lowest vacancy in the Eastern Seaboard states, and that is where we still get strength in our effective rent series, probably because of that. Land supply is limited. Further opportunities tend to be further out of the core industrial precincts of South Dandenong. So it's a really positive story for the southeast of Melbourne. Next slide. This is the vacancy by suburb. Now, this is interesting because you can see, yes, there's some vacancy dotted through those precincts, but Dandenong South is still only 1.6%. The precincts that have a lot of vacancy tend to be, well, Truganina is the highlighted one there, and Derrimut in the west. That's where we've got a lot of industrial vacancy. So that's what we have to keep an eye on. Now, next slide, Kat, please. But going back to the southeast, Dandenong South, you'll notice that the available supply is 91% pre-committed already. And look at it, there's no supply in the southeast. That land supply story is really having an impact. It's impossible for a lot of expansion in that market. Whereas Truganina, there's a lot of supply, a fair amount of supply coming. It is 44% pre-committed. So if you had to pick either market, you would go for the southeast any day of the week. Next slide. Story is similar for Sydney. Sydney's outer southwest is the market across the eastern seaboard states with the highest vacancy at 6%. Next slide, please. And you can start to see that which suburbs are seriously impacted. The Moorebank, 11% vacancy. Next slide. And again, a weaker story for absorption in Moorebank versus Eastern Creek and Horsley Park. I suppose, next slide again. Really what I'm trying to say here is that we have to be incredibly selective. So my final themes are for a fragmented market recovery. The population growth and e-commerce expansion drivers for demand are absolutely there. The land constraint in the precincts are likely to outperform the outer ones. We've still got a lot of 3PL inventory right sizing, and while consumer confidence is soft, we expect that right sizing to happen for some quarters yet. But it is pleasing to see manufacturing resilience, and as geopolitical challenges continue, there will be some strength in that sector. The elevated construction delivery is likely to slow quite sharply by mid-2025, and that is good for existing assets. We do expect our values in industrial are close to the cyclical trough in most markets. And I suppose the sustainability and the energy transition, the only comment I really want to make there is we spend a lot of time considering what the impact is of the Australian sustainability reporting standards which come in next year, and how it could impact industrial logistics. Whilst the rating of industrial logistics facilities is not quite as, it's not as mandatory as it is in the office markets, what is becoming clear already, investors are looking for assets that are capable of retrofitting to net zero capability down the track. We've got plenty of research now which shows that occupiers are looking for that kind of facility down the track because they need to be able to report it within their scope 3 emissions. So keep an eye on that conversation for industrial logistics going forward. Now I'm going to just finish there. I'm going to hand over to Trent to take you through some of the detail and some transactions. Thanks, Trent.
Thanks, Annabelle. Hello to everybody online. I'll just wait for my slides to come up so I can talk to. Hugely comprehensive there from Annabelle, and really appreciate that. Look, my presentation is going to be more focused just around a little bit more nitty-gritty on what I see day-to-day, key themes from it as investment strategies that I'm dealing with my clients. We've gone through an evolving market over the last 3 to 4 years, particularly since COVID and the emergence of industrial as a defensive asset class, and what that means and what's going forward. So if we can please proceed to the next slide. So look, 2024 key themes, market transparency, stabilising cost of debt has been huge, not just for industrial, but across, I think, all three commercial sectors, i.e. retail, office and industrial. And look, if you have a think about what's happened since COVID emerged, and Annabelle's slide earlier on the commercial real estate value correction, i.e. property cycle, and where we sit in comparison to those other asset classes, I think tells a big story. First cab off the rank since COVID hit was definitely retail as a result of the inability, for people to go and shop and leave home or stay within a 5K radius of their houses, and too scared to go into shopping centres. And so there was a real correction there and understanding about retail sales. And conversely, then came office, and we really lacked transparency in the market as to where those asset value corrections sat in comparison to industrial, being, no matter where anyone was, whether they were stuck at home, able to return to work, we're all consumers, and with consumption comes the need for manufacturing, the need for storage, the need for distribution. We had, significant supply chain disruption, both domestically and offshore, which resulted in a lot more product being stored on Australian shores in logistics warehouses that was previously able to be, known delivery dates from overseas that no longer existed. So the re-rating and the transparency of that cost of debt now has allowed all three sectors to, I think, have a re-rating and understand where internal rate of returns now sit. And naturally, that's evolved in a greater level of transaction volumes. Now, what does that mean in terms of asset value going forwards, and where are the growth? Some counter-cyclical investment groups might perceive that office and retail might have a little bit more value add in the medium to long term. However, there's been no erosion in value for industrial. And as a result, it's been very highly sought after. I think cash flow security, in recent times in industrial has probably been seen to be a little bit undervalued. And I'll touch on that further on. There's, as Annabelle said, there's been significant rental growth in recent years. And is this sustainable? Look, my gut feel is it probably doesn't need to be, and we can talk to that. If we talk about the prime yield graph that Annabelle had earlier on, for industrial particularly, prime grade yields only 2 years ago were probably sitting around the mid 4.5% range. Now that's now looking closer to probably a 5.75 average prime yield. Now, what does that mean in terms of market value and asset value stabilisation? Well, what that translates to is that you need a rental growth amount of roughly 27, 28% in order to hold value. Now, we've probably seen that, to be honest with you, over the same period of time. The real catalyst and uncertainty that we found during an unwinding investment cycle was that no one knew where it was going to stop. And look, if it went from, say, 4.5 to 6.5, then all of a sudden that rental growth piece has to go from 28% up to 44 or 45%. And all of a sudden there would be a risk of asset value erosion in the industrial sector. Now, that doesn't look like it's transpiring, which is great. And I think that's now driving more investment back into the market as well. Fourth key theme, investment market hasn't priced in vacancy risk. And I'm wondering whether that changes over time. Naturally, we're trying to see the economy slow. And what does that do for business sentiment, consumer demand? Look, it's due to slow it down. So I think we're now seeing a genuine movement that industrial occupier demand and mandates have tapered, albeit off such a strong result over the last couple of years that it's not necessarily a bad thing. So we might start to see key themes returning for long WALE cash flow security coming back in vogue, when typically we haven't seen that due to the fact that it offset strong rental growth. And I can give some classic examples in that the market was really averse in recent years to any long WALE investments because of the rental growth story. So if you're locking in an investment for a 15-year cash flow at yesterday's rents that have now experienced 30% growth, that you can't then materialise for theoretically 15 years, well, those returns just don't stack. And what we've even found in the nitty gritty of a lot of these leases that were never really a consideration was that under the option review mechanisms, there were also built-in cap and collars. So what you might find is that you might have a 7 or 8 year WALE that you theoretically might be able to revert the passing rent back to market. However, if there's a 5% cap and collar on those, then all of a sudden that inability to return to market beyond the existing term and theoretically for an additional 2 or 3 5-year option periods made those investments look a lot less appealing. So that was the real aversion as to why cash flow, long WALE assets were less sought after compared to short-term WALEs. Now, if we start to see vacancies tick up, and as Annabelle touched on, incentives start to rise, that's eroding future rental growth, and we start to see a return to more historical norms of, say, 9 to 12 month letting up allowances with 20% incentives, then all of a sudden maybe cash flow security long WALE assets do come back into play, particularly if the growth piece stabilises along with the cost of debt. So time will tell on that. Just also wanted to touch on construction costs remaining high, albeit having appeared to have stabilised. And what does that mean for the market? We've effectively gone on the eastern seaboard, construction costs from circa $750 a metre for an industrial facility up to probably $1,500 or $1,600 a square metre. That's translated into the rental growth story in itself as an economic return on cost. There was an expectation that maybe land values decline as a result of that in order to make the developments feasible. But we just haven't seen that. I think there's been a move from occupiers away from being tenants to try and be owner-occupiers and therefore holding up land values. And finally, I'll just quickly talk on state versus state. I think a lot of people on the call might want to just understand how the market is performing on a state-by-state basis. Can I go to the next slide, please? So I've just got three key transactions that I just wanted to talk on quickly. Queensland, New South Wales, Victoria, all similar stories. Short WALE, this one's recently occurred. Initial yield is reflective of under-rented stories, which is consistent throughout the market, and equivalent yields are based on market rents and when we can actually revert that back to market. So you can see that what we've found across most states is that initial yields touching circa 5% is really the floor on where the investment market's happy to get a return in the short term before they can return back to what they perceive to be a market return of circa 6%. I think the divergence in yield spread between New South Wales, Victoria, Queensland has always been roughly 25 basis points, Sydney being the tightest, followed by Melbourne, followed by Brisbane, and then another 25 with South Australia and Perth. I think what we're finding is that the gap is narrowing between Melbourne and Brisbane in the short term as taxation and legislation changes play out in Victoria. But as we've seen, population growth and can really drive that. And I suspect that'll be short-lived until the market works it out. Conscious of time, so we can flick through the next two transactions, just similar stories. 4.5 year WALE, mid-5s equivalent yield, gives that disparity between Brisbane being 6 to 6.25. Initial yield sitting at circa 5%, as we touched on, fully leased. Next slide again, thanks. Victoria, similar story, equivalent yield 5.7, initial passing, it's only short-lived, 1 year. So again, gives that disparity in equivalent yields play, 5.5 for what's perceived to probably be prime yields for New South Wales, 5.75 to 6% for both Victoria and Queensland, and 6 to probably 6.25 for South Australia and Perth. Next slide. Just cycling back to the rental growth piece and where we see that divergence. This is just a quick example of what we saw locally here for me in Brisbane on a pre-committed facility back in 2023 at 145 a metre net. Now, as that property was nearing practical completion, the tenant vacated or removed their commitment. It was subsequently snapped up very quickly by another group, and you can see the divergence there up to 192 a metre, showing roughly, I think, about 30% increase in the 12 months. Now, that gives further context as to how there's been value hold across the industrial market over that time as yields have unwound from circa 4.5 through to 5.75. Talked about the investment market not building in vacancy risk and also construction costs remaining high. So next slide, please. So finally, I just wanted to touch on the varying investment strategies that we're seeing, where the different appetite lands. I've touched on the long versus short WALE investments, and there may be a return to long WALE assets being perceived to be prime and cash flow security if we start to see prolonged vacancy, and that's something to keep an eye on. I think it's worth noting that specialised facilities such as cold storage logistics typically had a divergence in yield spread between traditional industrial assets of 100 basis points. That's really tightened, and the cold storage market has performed really well in recent years, really low vacancy rates. And I think, what was perceived to be specialised and therefore a higher degree of risk of reletting, that rhetoric has moved away. And because of the high construction costs across the board, that has also driven significant rental growth in this space, because the replication of an asset is so high that one, it allows a tenant to probably remain quite sticky, but B, in order to when it comes to a market review, you understand that in order for them to be attracted to a new development is going to probably jump in rents significantly, which will allow existing facilities to still maintain some reasonable and quite healthy rental growth. Spec development we talked about through Annabelle is probably tapered off the back of the leasing market starting to just subdue slightly. So I think there's been a reluctance in recent times for any spec development or without any pre-commits. Small versus large distribution, we've seen the smaller end markets remain really strong across all states. And so this sector has performed really well. Now, you couple that with the fact that the institutional groups are probably removing themselves from being in the sub 20 mil market anymore. During the tight yield cycle, we found that the institutional group started to dip down into those markets due to the inability to be able to buy anything else. As the market started to stabilise, they're retracting out of that market again, yet it seems to be the space that's generating the most stable level of demand, plus also healthy rental growth. So something to be mindful of there. Varying investment strategies. The last two probably are tied into each other. Modern facilities versus dated construction. Because land is still so tightly held and performing so well, older style construction with capex exposure might be seen to be problematic. However, your underlying land value is really propping up those values, and so your downside risk is pretty nominal. You've coupled that with occupier demand remaining strong and rental growth remaining well. In many of these instances, they're probably the most value and risk averse in compared to a modern facility. So those are the things I wanted to touch on there. And Annabelle also mentioned hardstand. It's interesting to note that we've seen a real jump in hardstand values and rental growth in this space, and that's basically a function of the opportunity cost of tying your land up to a hard stand user as opposed to developing it. So with land values continuing to grow, and then you got coupled that with rental growth, plus the cost of concrete and the ability to actually cap the land with hard stand. We've seen hard stand rates go from sort of $35 up to 65 to 70 in the wider Brisbane market, and that's a common theme across the country. So that's just a few local themes I've seen and noticed here, and I'll throw you back. I'm conscious of time. We've already nearly run over, so thank you, everyone. I'll throw you back to Michelle.
Thanks so much, Trent and Annabelle. They were fantastic presentations, lots of information for everyone's consumption there. Annabelle, I might just ask you to come back on screen and we'll just have some Q&A. So I actually do have a question just about data centres, because we do hear a lot of talk about that at the moment. Trent, do you have a view on the data centre opportunity?
I can talk to data centers quickly. Not exactly my wheelhouse, but certainly a very sought after asset class, albeit quite specialised. There's a lot of themes around data centers, and they need to be positioned next to significant power and supply. They also need to be in a location that's perceived to be quite stable, both environmentally and so. Yes, it's again a sort of a buzz sector, but certainly an emerging one that's going to take a lot of investment appetite should it be available. It's still an emerging space, so it's hard to actually allow the capital to find a home yet in Australia, but it's something that we're keeping a focus on and is certainly a growing space.
Great, thanks, Trent. So Annabelle, there's a couple of questions here that are linked to interest rates. So we'll start with this one, which is with growth in cap rates and potential for rate reductions in the near future. Do you anticipate larger industrial funds such as Charter Hall to begin shifting their focus back to smaller industrial properties?
That's an interesting question. I think the first thing is that although people think interest rates are going to come down, I think many would, certainly our house view is if they do come down a bit, it'll only be a bit. So it's not going to be back to sort of negligible interest rates we had a while ago. So that's the first point to make. Hard to say in terms of whether the lot sizes will change. For a group like Charter Hall. I don't know whether, Trent, you've got a view on that.
Yeah, I suspect not.
No,
there's been a retraction in that space from Charter Hall and a few of my other clients as well. So I think they understand that their wheelhouse, that in the space that they best perform and understand and want to behave in is probably 30 mil and above. So yes, as I touched on, they drove into that sub 20 mil market during the peak of the cycle as a result of just a lack of opportunity. But I think they're moving away from that and moving back to larger scale and medium scale assets. Not to say that a development can't house a combination of larger scale tenancies and small scale. But in terms of asset pricing, where they want to be, it's certainly over 30 mil.
I think that there is one comment to make around Victoria and what we've done some analysis, which basically shows that the larger lot sizes tend to be impacted by global capital or have global capital behind them, and therefore they are the groups that are exposed to the new foreign owners surcharge, the land tax, and so that might sort of stimulate further activity in the Victorian market when it comes through.
Great, thank you. Just in terms of the expected reduction of migration, how do you think that's going to impact projections in the next 3 to 5 years?
Yeah, the forecasting houses for immigration. It's not an exact science, because you're right. There is supposed to be this pullback in immigration. The political classes are pushing for it. But I do think it's all relative. I mean, certainly the forecasts that say the ABS come out with, they have a high and a low and a higher, low, and a medium, and then the Oxford Economics has theirs and Deloitte Access Economics has theirs, and they adjust them from time to time. It will impact potential volumes of demand going forward, but I think the overarching message for industrial is that because of the e-commerce story on top, we just simply probably not really building enough to keep up even with the volume of population that we will grow to.
Okay, great, thanks.
And there's no intention to shut the borders completely. Yeah, I mean, look, you're right. There's a whole world of complication because there's that sort of dips into the residential housing affordability discussion as well. But it's I think if you look at the broad brush numbers, even a poor work bag doesn't actually really impact the industrial sector. Great deal.
Great, thanks, Annabelle. Trent, I'll go to you. Just a quick question here on thoughts on movie studio space in Brisbane and Gold Coast markets.
Movie studio space. It's an interesting question because it's already occurring in traditional industrial facilities. So what I've seen, Gold Coast has obviously been, has attracted, some activity in that space. I've actually valued a number of sheds that might have a Netflix show being developed there. There was another example down at in between Brisbane and the Gold Coast where they were doing another movie that had underwater scenes and they had internal pools being developed inside the shed. The only thing I'd caveat to that is that these occupiers are typically only there for 12 to 18 months. So yes, it does take up some of the industrial space, but it isn't, they're not committing for, traditional 5-year lease terms. But it has become more prominent through the Southeast Queensland market.
Great, thank you. Annabelle, back to you. Just considering the relationship between population growth and land supply, do you think that Sydney's likely to experience the strongest price growth due to their availability of land?
Good question. I think the way we've Sydney's always, apart from certain pockets, it's always got land constraint, because it's not as flat as, say, somewhere like Melbourne. So the answer is yes, potentially. I think you get limited ultimately by the consumer demand, but yes, I think for most. But again, as I was trying to explain in those slides with the maps, some precincts are extremely constrained. If for occupiers that want to be in those precincts, they have little choice. But there is a limit because we're already seeing many conversations now because of that differential between Sydney and Melbourne, of some groups considering relocating their national DCs to Victoria and servicing Sydney from Victoria. Not many examples. I think we've actually only recorded two that have actually done it in our numbers. But there's certainly a lot of talk about that because there is a price point at which Sydney rents become too much.
Okay, great.
So that did answer that.
Thanks, Annabelle. We'll have to wrap up there. So I hope everyone's found today's webinar interesting. There was absolutely some fantastic data presented. So thank you so much to Annabelle and Trent for sharing your expertise. And thank you so much to our audience for dialing in. For our customers on the line, I'd really like to take this opportunity to thank you for your custom during 2024. We do appreciate your business and the relationships that we have with you. And NAB's committed to working with our customers to find solutions together. So please speak to your banker about any new opportunities or any concerns that you may have. And if you'd like to explore interest rate strategies, we can put you in touch with our market specialists. You will receive a survey as the webinar closes. We do appreciate it when you take the time to provide us with feedback, along with any suggestions that you'll have for future webinars for next year. I'd like to take the opportunity to wish everyone a safe and happy festive season and look forward to seeing you at our next webinar in February. Have a great day and thank you and goodbye.